Hey everyone, let's talk about a question pretty much every saver runs into. How do you get your money to work harder for you? But, without all the stress and sleepless nights that can come with playing the stock market. Well, today we're diving into a really clever strategy for that.
You've been there, right? You see a great interest rate, but the catch is you have to lock your money away for years. On the flip side, you want to be able to get to your cash whenever you need it, but that usually means you're stuck with the interest rates that are, frankly, pretty pathetic. It's the classic saver's dilemma. And this trade-off, it is so frustrating. It feels like you're being forced to pick between actually growing your money in a meaningful way and having the flexibility you need. But what if you didn't have to choose?
So let's just look at the two extremes here. Over on one side, you've got a high-rate certificate of deposit, or a CD. It offers a fantastic annual percentage yield, a great APY, but your money is completely locked up. And on the other side, a regular old savings account. You've got total liquidity, you can pull your money out anytime, but the interest you earn, it's often barely anything. You're pretty much forced to pick one good thing and accept the bad thing that comes with it.
Okay, but what if there was a way to actually get that high APY and still have regular access to your funds? What if you could actually have the best of both worlds?
Well, it turns out there is a way. It's called the CD ladder. And it's a really elegant solution that is designed to give you exactly that, higher yields plus regular access to your money. So what is it? A CD ladder is a strategy where you don't just dump all your savings into one giant CD. No, instead, you split it up. You put it into several smaller CDs that all have different maturity dates. And that's staggering. That's the secret sauce. It's what gives you both those higher rates and that regular cash flow.
Okay, here's how you actually build one. Let's imagine you have $5,000. You put $1,000 into a 1-year CD, another 1,000 into a 2-year, then a 3-year, a 4-year, and finally a 5-year CD. Now, when that first 1-year CD matures, you take that money and you reinvest it in a new 5-year CD. You just keep doing this each year. And by the time you hit year 5, your whole ladder is made up of these high-yield 5-year CDs, and you have one of them maturing every single year. And this is the end game right here. You create this awesome system that gives you access to a chunk of your savings every single year, all while the rest of your money is working hard for you in those long-term, high-interest accounts. It's predictable, it's powerful, and it's pretty brilliant.
But you might be asking, does it really make that big of a difference? Oh yeah, absolutely. Just look at this comparison. Over 5 years, 10 grand invested in a CD ladder could earn something like $2,200 in interest. That same $10,000 in a typical savings account, you'd be lucky to get $500. That is a huge, huge difference. And it's all from being strategic, not from taking on more risk. Okay, so you see the potential. It's pretty compelling, but how do you actually go about building one? Well, here is a simple 3-step action plan to get you started. First, you gotta decide on your structure. How many rungs do you want on this ladder? Are we talking 3? 5? And what's the longest you want to go out? Second, and this is super important, shop around for the best rates. Do not just take whatever your current bank is offering. And third, set reminders in your calendar for when each CD is going to mature. That way, you can be proactive and reinvest at the best new rate you can find. And seriously, do not sleep on that second step about shopping around. It is so, so crucial. It is where people leave a ton of money on the table. The rate difference between banks can easily be 0.5%, even a full percentage point. On a $5,000 ladder, that's up to $500 in lost interest. A few minutes of research will literally pay for itself. Now listen, no financial strategy is a magic bullet, right? And it's really important to have a balanced perspective. CD ladders are fantastic, for sure, but they aren't perfect for every single person or every situation. So let's take a look at the full picture. On the pro side, you get this amazing rate protection. If interest rates go up, your CDs that are maturing can grab those new higher rates. And if rates fall, well, your longer-term CDs are already locked in at the old, better rate. You also get that structured liquidity we talked about, predictable returns with zero market drama, and of course, the peace of mind that comes with FDIC insurance. Your money is safe.
Now, for the flip side, the cons. There is an opportunity cost. You're giving up the chance for those bigger stock market returns in exchange for safety. And high inflation, that can definitely eat away at your real earnings. And yeah, while you have some liquidity, you have to remember that most of your money is still locked up at any given time. So, keeping all of those pros and cons in mind, the big question is a CD ladder the right move for you and for your money? Let's figure that out. A CD ladder is almost perfectly designed for your midterm goals. We're talking about things that are maybe 2 to 5 years down the road. Think about a down payment on a house, a new car, or saving up for a wedding. It's for those times when you absolutely cannot afford to risk the money you've saved, when you need certainty, and you know you can set the funds aside for at least a year or two. So where does it not make sense? Well, there are two big areas. First, your emergency fund. That money needs to be available instantly, no questions asked, so a high-yield savings account is a much better tool for that job. And second, for really long-term growth, like your retirement savings that are decades away, the stock market's historical returns will almost certainly beat CDs over that kind of time frame. And hey, remember, that classic 5-year ladder we talked about isn't your only choice. You can customize this. You could build a mini ladder with shorter terms, like 6, 9, and 12 months, for more frequent access. Or a barbell ladder that just focuses on short and long-term CDs. There's even a bullet ladder where all your CDs mature at the same time for one specific big expense. The main idea here is super flexible. I think this quote just sums it all up perfectly. A CD ladder is a good investment if what you mean by good is safe, predictable, and way better than a basic savings account. It's not about chasing the highest possible growth. It's about optimizing safety and getting a solid yield. So that really brings us to the final question, the one you should ask yourself. When you think about your savings goals for the next few years, is predictable safety your absolute top priority? If your answer to that is yes, then the CD ladder might just be the smartest, most elegant tool you've been looking for.